All right, so good afternoon to the last session of the first day of our spring conference. Got Ron Rudich getting ready to talk to us about the business valuation after the Tax Cuts and Jobs Act. And I've got a brief introduction here let's talk about. So Ron's primary area of expertise is in the valuation of closely held businesses, litigation support services, machinery and equipment appraisals, and pretty much everything else. Ron performs valuation services for scrutiny analysis of an opposing business valuation report, preparation of deposition questions, gift and estate tax related issues, marital dissolutions, pricing of transactions. I'm going to read this whole thing. Structuring analysis, including mergers, acquisitions, all kinds of stuff. The last paragraph. He's been he's prepared business valuations for court cases, depositions. He's been an expert witness in business valuations, divorce proceedings, and bankruptcies. Now, bankruptcy court would be a fun one to get into. Just because we have a couple of housekeeping issues, people have been asking some questions about a couple of things. I'm taking 2 more minutes of Ron's time to talk about other courses we've been advertising on the table there. Litigation support class. You ever wondered what it feels like to be cross-examined on the stand? Come to class, we'll do it for you. And we'll record you so you can see what you look like when you're being cross-examined. And this one is, a lot of people want to know how to do evaluation using Microsoft Excel. I'm going to teach how to build a template and basic valuation stuff. It'll be pretty easy. And Ron, take it away.
Take it away. Wonder if I can do that. Yes. Okay. This was enacted, as we know, around December 20th, signed by the President, December 22nd, 2017. Now, I know it's more than a year later, but in the nature of business valuation, there's nothing to say that we won't have a company who will say to us, well, I want a valuation as of a particular time in 2017. Now, one of the pretexts that we learn with regard to valuation, you know the words known and knowable at a particular valuation date. So if you're asked to prepare one at this, September 30th, 2017, are you going to take in consideration the TCJA and the representation that taxes were reduced? What are your thoughts on that? Chris?
We will take into account the market's reaction to the anticipation of the passing.
Correct.
Which is reflected in the market prices of the stock in the market.
Yes and no. How about the transactions that we pulled down either from Deal Stats, aka the old Pratt, BizComp's Deal, IBA, and mid-market comps? We haven't seen enough, even in this past year, enough transactions that would warrant or for us to know that that implication of the TCJ is already built in based on those company cash flows.
We know it's built in the public marketplaces because we saw
yes.
And there's been studies that have been done that said the run-up in the stock price during 2017
and hopefully in your own portfolios, yes, that's true.
Yeah, I mean, Mercer Capital did an extensive study on it and concluded, and they actually have, if you go and get the article, you can see their conclusion as to how much of the stock price, how much of the market change was reflected, or how much of the market change reflected the anticipation of the tax cut. And as it got closer to year end, and it became more evident that it was going to pass, obviously the market reacted accordingly.
And what he's saying is we should have an understanding. The market usually is 6 months ahead or projecting 6 months ahead of where we are today. They're going to take in consideration things that they recognize. Now, we have empirical data such as the TCJA going to be signed into law, and then you have heartfelt things like, okay, the president's going to do a deal with China, so the economy is going to get better, and then prices go up. So you have to understand the dynamics that's built in to particularly the stock market. But for those of us who do a plethora of valuations for companies under $20 million, we're not going to really find a lot of public company data that we're going to utilize. We're going to utilize the databases for at least the market approach. Okay? And we say the future impact on businesses and the cash flow. We're going to consider, as we will discuss today, the impact on the approaches utilized and assumptions relied upon, which you're going to find hopefully interesting if you haven't given it any thought. Because of the less tax, we're going to find that built in now in the cash flows, since companies paying less tax, then there's going to have more cash flow. It's going to increase in the income approach in its most simplest form. So are these companies actually worth more? Or they're only worth more during the 8 years that we have the TCJA? Conversely, we're going to be discussing looking at the WACC with regard to the income approach. And since there's restrictions on interest, and interest as an add back, then the discount WACC rate is going to be higher. So if the discount rate is higher as a divisor, less value. Okay? So on one hand, in what we do in the income approach, value is going to increase, and in another way, value is going to decrease. I mean, it really, yes.
What you have to take in the structure of the company, whether it's an S corp or a C corp or a partnership, because
Well, we're going to get there, particularly with the PTEs, yes. What you're referring to is with the C corporation. Now we have companies that are going to be, all C corporations are going to be taxed at the very first dollar and thereafter at 21%. Now, where companies are going to, where we're going to have problems with some small companies, if let's say they're earning $50,000 or less, they have been used to paying less tax because it was a smaller bracket before. Now 21% may cause them to pay 6% more in taxes on the federal side. Okay, so there
is the minimum.
it's flat.
It's a
it's a
flat.
flat. As I say, on the first dollar, 21%. So then we have on the individual side, when we're dealing with PTEs, pass-through entities, and we know the sole proprietors, partnerships, LLCs, and S corporations, that the shareholders are going to be taxed. And what I do is I utilize the personal income tax, not the C corporate tax, as the tax that I would utilize when I tax affect the PTE, and I'm in that camp. I'll tell you right up front. I'm sorry.
It also means that all the past transactions will pass through courts. There's no change, because that's what most people will be doing, is hitting at the personal income tax.
Oh, yes, that's true. But I hear different people say that when it comes to S corporations, they were taught to tax it at the C rates. Okay? But whether I'm going to say Van Vliet, Horn, and Nancy Fannin, and so forth, they've all come out with it for years now saying, oh, well, we should be considering a premium for the S corporation because it's worth more. And I've written a white paper on that, but they never fully took in consideration the tax affecting and what was left in the shareholder's pocket. You as a shareholder in a pass-through entity, are you concerned with what you have to pay sometime in the future in taxes, or are you going to relate it to the cash flow in that entity? Well, I've always thought it's what am I able to walk away with? That's the value to me, okay? So in that aspect, what I have a lot of senior moments. You have to bear with me because my mind skips all over the place. It's important to recognize that if you have multiple shareholders, you can't use the gross cash flow and its ultimate value. You're going to have to break that down in value if you have 5 partners and divide it by 5, because that's the portion of the income that's going to be reported on that particular shareholder's income statement as personal tax return, and then the tax rates are going to be lower. Yeah, Frank?
So you're trying then to match the income from the business directly to the personal tax rate, as to not just take the maximum? Is that what you're saying?
Yes.
So if this business is, well, let's say this business is making, $100,000, and there's two owners. You're gonna tax that, each of them at a $50,000 tax rate per person, not knowing that, perhaps they're making $500,000 somewhere else?
Well, let me add a caveat to that. My three-legged stool in valuation is the standard of value, the premise of value, and the reason for the valuation. Okay? So if my reason is not for that hypothetical buyer that's coming in, and maybe it's a divorce, or it could be a valuing a non-compete, or something along those lines. I have known individuals. I'm really out of the realm of fair market value in that sense. Then I'm going to break it down. But if I'm using it in a context for a hypothetical buyer, I'm going to have to tax it at the full amount, because it may be just a single owner who may be ultimately buying it, and I could have 2, 3, 4, 5 partners in that company.
Is it the first dollar of earnings, or is it the last dollar? Basing the tax rate on it. Or, in other words, like I said, if the household is making, has 200,000 of other income, and the business adds 100,000 to it, are you tax affecting the business at 100,000 or 300,000?
Oh, I know where you're coming from now. And I've often thought about this, but I'm not privy, except for their tax returns sometimes, as to what's and I'll be very frank, my wife is an artist and prepared centerpieces and themes for bar, bat mitzvahs, country club affairs and whatnot, and for many years she made more than I. So that could very possibly be an impact on a lot of personal wealth. And the business owner, I don't know what other income he's having. So I'm just taxing what I see from that business standpoint. I'm doing it from the step rate based on the lower tax rates that we have now. What used to be 39.6 is now 37. So what used to be 29 is 27, and 25 now 20, and so forth. But when you go into a pass-through entity, then in essence, what you're finding out, as opposed to comparing it to a C corporation, that particular PTE owner is actually still paying more taxes, even if you consider sometimes the double taxation in a C. But if you're looking at a straight eye to eye and level to level, I don't see now today, particularly because the personal tax rates are much, much higher than the C corporation. You have a huge disparity now, and that doesn't equate to me in my math to a premium for the S.
Frank, maybe this is what, like our models, we're still using C corp rates. We're going to use that 21% rate on the DCF, but then we also have a factor that will adjust that DCF value when we run it through our comparative C corp rates and personal rates. Is that what you're saying, really? Are you plugging in? You're not plugging in a personal rate in the DCF model, are you?
As a tax, yes. Absolutely.
Well, we probably are getting to the same place, because we're running it at 21, and then we're comparing, how much money's left over under a C corp or under a pass-through entity, and then coming up with a factor and then applying that to our number.
Okay.
Then you're effectively using
Pardon me?
You're effectively using the maximum personal rate.
Yeah, or whatever it would be for that income level, that bracket.
Okay.
So basically, we're boiling down to use a marginal or an effective tax rate.
Effective.
Yeah, you're using effective, you're talking about marginal.
And what I'm also doing, it's a blended tax rate. I happen to be in one of the 39 states that have a state tax. So I'm in Maryland. We have a 5.75% for the state, and the county that I'm in is another 2.81. So the state max for my county is going to be at 8.58%. And so I subtract that from my operating income, then my taxable amount for the federal, then I'm adding back in the state, and I'm getting my composite blended rate, and that's my tax for the individual.
Do you sometimes just look at the revenue that the company is throwing off for the owner and then tax it at that bracket along with the earnings in it?
Why just revenue?
I said earnings and revenue.
Oh, earnings and revenue. I'm looking at the earnings.
Okay.
Okay. We have, it's not really getting into this a second, but since you raised the question, those of us who look for small companies and we get into pulling the IBA or BizCom's data for companies, I would say primarily 5 million or under, we've always relied on the revenue as a guidance because that was more believable than the SDE, the seller's discretionary earnings. Okay, but I have found over time and many, many years of doing this, that is graphed, if you will, individually by the owner differently. So it's a hard number to quantify. But then the people who are contrarian and saying you shouldn't utilize the revenue because that could be a controlled number. Because if it's coming from income tax returns, some people hide and they're not reporting all the revenue. But the SDD happens to be I would say a sister composite number based on that. So I utilize the revenue more. But I'm one who teaches and utilizes for many years now regression analysis. So you can't arbitrarily use those metrics unless you use regression to know you have good comparability and continuity between the data. Consideration must be given to the impact of the new law on the value of the equity ownership interests. Simple illustration of a C corporation demonstrates impact. Assuming a constant risk, not realistic, the expected future economic benefit stream is immediately increased by the delta between the previous rate of 34% and the TCJA of 21. We already discussed that. We'll go into more illustrations. Assuming $1,000 cash flow pre-tax before and after the tax reform, the numerator will increase from $660 to $790. Just basic of that 13% difference. So the important question I constantly hear about, how all of a sudden is a company now worth more just because the tax rate is lower? Now, we don't know. We were talking originally about known and knowable. Do we know after the sunset, supposedly of 2025, this is going to continue? Well, the 21% was made permanent. Okay? It's not to say that Congress couldn't change their mind again, because we know, but that's a whole other bag. But right now, that on the C corporation side, that's where it's going to be. But when it comes to personal, now we have, idiots out there who are saying, well, the rate should be raised to 70% and should be raised to 90%. Okay? These people never studied economics or anything else, but that's another ballgame. So provisions that will impact valuation: critical dates, corporate and individual income tax rates, the limitation on the deductibility of interest, okay? Capital expenditure cost recovery, research and experimental expenditures, net operating losses, temporary sunset provisions. All those tax laws, if you will, were changed in the TCJA. And it does affect us how we read statements and how we utilize that data moving forward. Okay? The critical dates, I'm not going to waste your time. We've been over that. Should probability-weighted consideration be given to expected tax rate decreases on the key pre-enactment dates, factored into the future expected cash flows, and factored into the risk rate determination? To what degree should pre-enactment expectations about potential tax reform factor into value determinations? Is it possible to separate overall growth in the public markets from that portion associated with expected tax reform? Okay, So we're no longer expected, we are in tax reform. Note that the S&P 500 price index returned 18.74% in 2017. There is no question that the returns were influenced by expected tax reform. The markets really have done well since the act. We reached and went over 26,000 in the Dow. Yes, we had a couple weeks where we tumbled maybe about 4,000 points, but it's touched over 26,000 again. The market?
Yes, sir.
Well, he's saying that the markets haven't impacted the risk-free rate?
Yes, sir.
Okay.
No, the equity risk premium.
Okay, well, the equity risk premium. The equity,
Well, Duck Health did raise their equity.
well, they went from 4.5 to 5, and now it's 5.5.
Okay.
So that's on D&P.
Okay.
But then they have roughly around 0.5% adjustment if you're using the data from D&P. So it has been about the
So it
same.
has, okay.
But for instance, when I'm using the build-up model, I start with my risk-free rate. The risk-free rate is a 20-year left on a 30-year bond. There's no such thing as a 20-year bond. And then within the Ibbotson/Duff & Phelps data, I can also pull up a 20-year equity risk premium. And I'm marrying 20 years of one item to 20 years of another item. So that's my bias, or what I feel is responsible. So there is nothing right or wrong about this. It's based on your education, your experience, and what you feel is correct. We know I can give you a set of financials, all of us in this room, and would venture to guess we would all come up with different values. Probably pretty close to one another, but differently. So that is part of the art. Many commentators expect tax savings to be significantly reinvested into the domestic economy through higher wages and additional job creation through capital investment, and it's exactly what we did find. Would not the same elements of growth be considered in the valuation of privately held companies? Now, I wrote something a while ago, and it still holds true today with PTEs, and a lot of people like to speak of it with regard to the S corporation. And inherently, with small businesses, they are paying a 100% tax. And this is never spoken of. So if you have on the K1 $500,000 and the owner pulls out $200,000 to pay his income tax, you deposit it in his checking account, right? Then he has to pay the federal and state, and they come to $200,000. What's he left with? Nothing. He paid 100% in tax on his distribution. But now you're going to jump all over me and say, Ron, he left $300,000 back in the business for reinvestment. And that's great. When's he getting it back? Okay? We don't seem to quantify that aspect of his investment. And too many times I see when people prepare valuations, if they get to the end and they properly do a justification of the purchase price, they're looking at the balance of the interest-bearing debt to the line of credit and maybe to the bank, but they don't take the owner's invested capital into concern. So you have to realize now his loan may be subrogated to the bank, that he can't take that out until the bank's paid off. I understand that. But you still have to look out past that point as to when he has been made whole or she's been made whole and go on. Yes?
If it's not left in there for working capital, is an arbitrary or discretionary non-deduction. And so,
It's not a deduction at all.
well, withdrawal too. So if he's leaving $300,000 in the business, so it's part of his equity, and it's a personal 100% controlled individual, and that $300,000 does not have, then that's a discretionary decision on his part, not to recognize. that tax at that time. So is it necessary for the operations of the business? And if it isn't, shouldn't we then automatically make it a distribution? Because if he's already getting a salary that's comparable to what he's working at, then that discretionary decision to not withdraw money when he could, and there's no reason for the business to have it, that would be considered a dividend to him. And so my point would be is, just because he's made an arbitrary decision based on personal preferences, and I've seen them where they've had CDs of $800,000 in there, and I've asked the owner, what are you doing? So, I wanted to keep it in the business so I didn't have to pay tax on it.
Well, you're bringing up another aspect that we're not talking about today,
But
but the value is there in the equity anyway.
yeah, and
So-
it rightly should be
All
condemned.
right, I'll get on another soapbox for a quick minute, if I may, because I can talk about this, everybody knows, all day. What is highly overlooked is the balance sheet, okay? Inherent in the balance sheet is whether there is excess non-operating assets. All right, there's excess non-operating assets and there's excess operating assets. So I went through peer review, and Howard Lewis was a peer reviewer, and I prepared a valuation, and this is what I did. Those of you who compare the company to RMA and then change cash or the receivables or inventory to marriage the RMA data, you have just now valued the RMA or industry data averages and not the company. You have just made a big mistake. So let's look at the cash. Now I'm looking at cash, marketable securities, accounts receivable, and inventory. Okay, so cash is cash. Marketable securities, is it designated or restricted or not? If it is restricted, I'm not going to pick it up as excess because they may need it for expansion or something else. If it is, I'm including that in my cash. Okay, accounts receivable, I need to go back and analyze the number of days of receivable. If I have 30 days of my turnover is such, I receive the receivables in 30 days, I have to convert that amount to no, if it's 30 days, that's it. But let's say it's 45 days and my accounts receivables are $450,000, then actually what I'm going to receive in a month's time is $300,000. And if my turnaround of a receivable is 15 days, granted, I'm going to increase it. Inventory, we had a client, well, the firm had a client that I would call them spice mixologists. So you walk into a restaurant like Red Robin and they have the bottle of the spices and you can pour it on. Well, since our tastes have gotten hotter, and I mean in taste, not in temperature, they buy from the Orient 12 to 18 months of spices in advance. So 11 months of the year they have excess inventory. Now, so let's pretend I just have excess cash. I have cash for $500,000. Then I look at all my expenses, my G&A and my COGS and my selling expenses, and let's say that's $1.2 million. So I divide that by 12, and I know it's on an average basis $100,000. Then I have a conversation with management, and this, because no business can operate at break even. They may or may not have a line of credit and so forth. So let's say they need a 20% contingency fee. So I'm going to add another $20,000 to the 100. So now I have $120,000. Now what have I not included? I need to subtract 1/12 of the total taxes paid and the monthly nut of principal payments on the notes. Okay, now I get down to an amount, maybe that's another $50,000. So that's 170. I subtract 170 from my 500. Okay, so now I have $320,000, and I've quantified what the excess cash is. Now, what do I do with that? So I recharacterize it. If you're using software, pull it out of your cash, move it down to an account that's called non-operating assets, and then the computer knows to pick it up and add it into your income approach and market approach, and that's what you were talking about, recognizing the value that was left back in. Okay, but depending upon the type of valuation, I still wonder, when's he getting that out? and what's the purpose of the valuation. But I wanted to at least bring that to the fore for you. You need to go through those types of exercises.
Because some of the companies have what in the past, they bulk purchase 2 times a year. The reason is they get extra discount that is not made available to them otherwise.
Right.
And they also get extra freight breaks because it's large quantity. And yeah, so if you order a train load, you've got 12 cars, yeah, you just spent 6 or 7 months, or they could be using it as hedging like Southwest did when the fuel prices went up.
Oh, they bought 6 years of fuel.
They hedge.
Right.
And that in itself has a risk that can't be really quantified. That's management risk based on fuel prices going up, except they really do understand if they bought it 4 years ago and we hit $32 a barrel, like maybe 2 years ago.
Right, right.
And so that's the small businesses like we deal with.
Yeah, well, but they can buy hedging too if they so desire. We've seen that. But we're getting a little bit far afield, but this is all good stuff. We need to understand the permanent versus temporary changes. Permanent is the 21% for corporate C corporate rates. Temporary are the bulk of a lot of things we're going to discuss till midnight tonight that have been changed with depreciation and interest and losses and QBI, quantitative business income, and that's also affectionately known as 199A. All of those factors are preying on our head and actually have now become to make our job harder, not easier. For what? Weighted average of what? For what?
What the pre-tax income is. No?
The pre-tax
Okay,
income?
so you're, okay. I'm not doing a very good job of explaining this, obviously. Here's where I was going with this. And that is so we had all these changes. So the question I'm asking is how do we make the adjustments to reflect, and I'm sure we're going to get into this, for
It's hot here.
with as far as like in December 31st of 17, if we have to go back and we're turning around and saying we're appraising or valuing the business, and we want to take into consideration everything prior to and everything after, I'm not sure I fully understand where we're going.
Okay. Where the most impact is in the DCF. Okay, if you're valuing a company and the company's never prepared a DCF, don't want you to doing the DCF because then you're valuing your own work, and that is very problematic. Notwithstanding that, if you do that, you're running you're a CPA. Okay, well, those of us who are CPAs, we're running afoul of SARS 23 and 25 a little bit. Okay, so, but that is a huge problem. Now, when we're jumping into a DCF, that if I have loss carry forwards, then the DCF must exceed the time period where the losses are absorbed. So by the time you get into the year of terminal to perpetuity, it's a good, clean, solid year without any impact from any prior losses, because then you're going to cause to understate value if you allow losses to impact the DCF. Okay, but now in this particular context, we have to be concerned with depreciation and interest and taxes, all right? And what are you going to do about the depreciation? Are you going to smooth that out over the useful life? Okay? Now, the losses, if you got all your information from the tax return, you're only allowed to take 80% of those losses in some instances. And you have a large company, and there's over $30,000 of interest, then they are deferred. Okay? So we have a lot of things that we're considering, and they need to be, like I always say, there's more balls now up in the air than ever before that we have to consider. Okay? Well, we talked about this, so let me move on. Permanent corporation is permanent for years after 2017, and that's a year we just finished. A proration of rates under Section 15 for tax years spanning effective dates of change fiscal year corporations. Now, as we get out into this period of 8 years of whatever you want to call it, better taxes, yes, better values, maybe, maybe not. What if you're in 2024 and you're doing a DCF? What are you going to use as tax rates in the DCF if you have no guidance from Congress what they're going to do the following year when it sunsets?
I thought you said it was just permanent. Didn't you just say it was a permanently at 21%?
That's C corporation. I'm back at PTEs now. Okay?
Well, that's right, it could be 2021, actually.
You have to go back to no and knowable.
You have to go back to known and knowable. So what we're saying is, if you jump into a period where the part of your DCF, you have a sunset period, then you have to revert back to old law.
Well, the other thing you could do is a Monte Carlo simulation, giving the weighted average of what events could happen and use the probabilities just to compile. That would give you a most likely outcome. And so
Monte Carlo drives me nuts, but
so
yeah.
that's 10,000 go through that iteration. It's just like
I choose 5,000 and I want to add one more.
No.
Look at
10,000.
that.
10,000. You have to go 10,000
I did 10,000 to refresh. Okay. So, but I believe there's a relative range where the numbers actually fall. I mean, let's call it the
well, you have your bounds
with a bounce, because it'll be like this. So if you can actually track the change, then that last number is pretty decent. But again, we're not in an exact business. I hate people who write in the reports that, oh, the fair market value in this particular instance is $1,253,654.
and 73
We're
cents.
not, and 73 cents, yes. And we're not in an exact business. Please round it up to 100, and if you can, round it up to 1,000. We are not in that kind of business. Possibly higher taxes and less cash flow to the small, oh, I discussed that with you, and I think that is exactly what's happening with the C corporations. Positive impact on the valuation of PTEs, as less cash flow will have to be distributed to equity owners to fund their tax liabilities on PTE income, even greater with the 199A deduction, which is interesting. Potential impact on the calculation of the S corporation premium, where corporate individual rate arbitrage was a factor in prior valuations. I can prove to you that the S is at least has a value of 0 as a premium as compared to C, and in most cases a negative amount that you wouldn't apply.
Well, in the service going after the studies on the owner's income to appropriate levels?
Well, it's been like this over the years, okay? This started, I would say, with fervor back in the 80s, and they term it that business owners should be taking a living wage, but they never have ever described what living wage is. So when a client asks me, a living wage is that bare minimum amount to cover your household expenses. What else could it be? I mean, if you're spending $100,000 a year for a mortgage and your children's education in private schools and taking vacations and doing whatever.
But that doesn't really jive with the fair market salary for the duties and time spent. Because the guy could have
Yeah.
a $200,000 lifestyle, but he's only in an $80,000 position if he was a non-owner operator. Nobody would pay him more for that. But because he is an owner-operator, he can afford the $200,000 lifestyle.
Yes.
So his level of poverty has just been raised,
Correct.
and therefore that definition, they're not using. They're using salary data.
Oh, they are. Again, another free salary data, go to the Department of Labor, and you can pull up their mean salaries for 1,000 different types of jobs by state. Okay? Huh?
Like metro area, you're talking about BLS.
Yeah,
BLS.
yeah. Well, it's through the DOL, the
Yeah.
Business the Labor Statistics. So, and it's excellent and it's free. So look that up, and it's really great. So and they print it out every May. So it's May 2017, May 2018, and so forth. And if you're trying to price a salary for a particular owner, then you can use the CPI change from then till your evaluation date and increase the salary a little bit. Now, what I do, we constantly get far afield, but that's me. You mentioned this before. If I have a company whereby the owner is actually doing 3 separate jobs, he's making a lot of calls at night, he's setting up appointments for the next day for the salespeople and whatnot, and then during the day he is running the business and also doing all the financials. I would have to hire 3 people, God forbid that person passed away, in order for the wife to maintain that business. And I can prove, which I've done before, he's working, let's say, 110 hours a week, and I will apply 3 salaries to him based on the average DOL statistics, and that becomes his personal goodwill and what he is worth. Okay? So keep that in your mind. The business interest limitation significantly changes traditional deduction for the business interest, limited to sum of business income, floor plan financing interest, and 30% of taxpayers' adjusted taxable income. Exception for small businesses, 25 million gross receipts test. Oh, okay. Remind me, 20 million, so I can come back to this. Real property, trade, or business can elect to be excluded from the limitation. Once made, the election is irrevocable. Okay? Trade-off is to forego bonus depreciation. Our job is made harder, I believe, and I think you'll agree with me, now that they've raised the threshold to be able to report on a cash basis from 10 million to 20 million. What are we supposed to use, and most beneficial in our work is accrual statements. Okay? I was just talking to a CPA who referred me a job, and she said, oh, all the data is either on this, in the financials, it's in QuickBooks, and reported to the federal government, it's on a cash basis. I said, I really need accrual. I said, hopefully, if they recorded everything properly in QuickBooks, we can push a button and see what accrual is. And if they can't do it, I want them to go back and provide me accounts receivable and accounts payable at the very least, so I can get a better comparability between years and know what the heck is going on. Now, I have one company that I do every year, and they still use a LIFO for their inventory. So if you still have any of those, yes, we have to increase the balance sheet inventory by the LIFO deduction. But don't forget the impact on the income statement. You need the LIFO comparison for all your historic years because you need to restate your beginning and ending inventories in the income statement. I see that mistake all the time. Another ball. Okay. So I think we have a real problem, and we're going to be seeing more cash basis statements. It's going to drive us up a wall. That's the point I'm making. Round 2. Amount of interest not allowed as deduction may be carried forward indefinitely, and I worry about that, whether a company can even absorb it in sometimes. But small companies that are working very closely and have losses, it keeps on moving. Applies to partnerships and S corporations at PTE level. Disallowed interest cannot be carried forward. It is treated as allocated excess business interest to be dealt with at the partner or shareholder level. So that creates another problem for us.
So as I'm turning around, does this mean in moving forward that I cannot add back the interest? Sir?
You cannot add
Okay.
back. No, you're going to be limited when you go from net income into cash flow,
Right.
the amount of interest you're able to add back.
Okay.
Now, with a lot of small businesses, you're going to be able to add back even if it exceeds $30,000. But if you're working with a larger company and they have been limited, you have deferral.
Okay.
Okay, that's going to impact another year. I'm telling you, this has created more work for us.
But the cap on the interest
Now,
is 30, Ron? Is that what you're saying?
Yeah.
Okay. All right.
So, another problem this presents with us is if we only get income tax returns and not financial statements, we need to be adept. If you're not a CPA, you're not used to working with tax returns, don't forget to look at the M1, and it says income or loss reported on their financials. You need to be able to ferret through the income tax return in order to change the taxable income on page 1 back into the book records. Okay? And if you haven't, then take a course, but take some time and get to know how to do that. Because there are like 50% limitation on meals and entertainment, and if the company properly reported on their books and records like penalties and those, they're disallowed 100%, and there's other things going on too. So, life insurance payment to a 2% owner and so forth and so on. So there's a myriad of things you need to be thoughtful of, besides timing differences.
Like when we get the tax returns and I can't get good company statements, I ask the CPA to produce the balance sheet, income, and cash flow statements that we use in preparation of those tax returns.
Very few will give them those.
Yeah.
No, they'll give me it, because they have to prep them anyway.
It might be a mess, but they'll
I just always worry if they're not adept at a cash flow statement. And you have to realize, too, a cash flow statement from a CPA is not cash flow that we're used to. In fact, that takes me to another jump. When we prepare the cash flow, I utilize Answath de Motorin and his process to discern incremental working capital from a business valuation point of view, not GAAP, current assets minus current liabilities. That's a big no-no for us. Those of you who want me to expand the difference, that de Motorin teaches that out of the net income, if we had no liabilities whatsoever, interest-bearing liabilities, then that would be a proxy for cash. So include cash in the GAAP working capital would be a double hit. Conversely, if we do have long-term debt, then from the net income, that's where the principal was paid. So that's a double hit. So you want to remove the current portion of the long-term debt from the current liabilities. You compare those and then compare the delta of each year and compare that delta to the delta of revenue, and then you'll actually see the amount of business valuation working capital attributed to the delta or increase or decrease of revenue each year. And that's the proper way to account for that in a real quick down and dirty.
Notes and receivables to the owners that had no paperwork and have not paid any interest or principal.
Well, I moved them down to equity.
Yes.
And in fact, do you realize of the IRS ruling last year?
No.
Okay. They are auditing that in particular. They're coming out more and more. So keep your heads, above water here. If you see a note to the owner and it's been sitting there, there is no bona fide arm's length note between the entity and the owner, and they've never paid interest, reclass it as equity. Okay?
The only where that is a problem is when I have multiple partners and only one of the partners has done it. And then you have a reallocation of partnership interest if you move it down, but there's no way to reallocate it. It's paid in withdrawals. And so that's an issue when I'm trying to figure out what a partner's value is in the business.
Well, I think it comes down to substance over form. If they can say and document to you, well, we've talked about it, we've never really done it, but we are all considering it notes. And I've done this in the past where I've actually seen an owner pay himself, let's say, and I have 6% a year, an average of the opening and ending balance of his loan. Then to me, they're treating it as if there was a bona fide note. And I keep on saying to them, please codify it, have an agreement, run it by your attorney, or make one up and sign it, have it notarized, so you can have it in your records, okay? They never know when uncle walks in the door and wants to check this kind of stuff.
Now, when I'm dealing with multiple entities that are affiliated owned, but with different partnership interests, and they have, let's say, a holding company, they're passing debt and resources from their cash cows to their new startups or to their bleeding entities.
It's similar with real estate. When you build up debt, when you use the cash and buy another house and keep on moving on the property.
And so the question that I always have is that at market rates? And are they paying that as an investment or as a debt? Or are they classifying it as a holding company and absorbing what should be interest to the entity that really loaned it out to? And then we're trying to consolidate all those into one entity to get a global evaluation.
Very thoughtful. Very good.
See
all the balls you got up there?
Yeah, but there's no documentation.
No, you're trying to be as thoughtful as you possibly can. Have I made mistakes? You bet. As much as I teach regression and remembering that when you utilize IBA and BizComp's data, they're asset sales. So you then have to transfer it from asset to an equity by adding certain assets, subtracting all the liabilities. But when I use regression, y equals mx plus b, the intercept can be the plus or minus. But if you use the truncated data, you're going to get a truncated intercept. And I made a $175,000 mistake. I forgot to multiply the intercept by 1,000. Boy, did I have egg on my face in that litigation. So it happens. That attorney will never use me again. But that was ages ago, but I did it. Amount of interest not allowed as deduction will increase the cost of capital in any given measurement period. You understand that? Okay. Particularly in a WAC. Okay? If my interest is limited, okay, when I utilize the amount of debt against the weight of debt, and if my interest now is lower and the equity is always much higher, I'm going to end up with a higher WAC discount rate. Therefore, it's going to cause the value to go down. And we'll discuss this further. So higher tax obligations due to the disallowance of certain interest expense deductions will potentially decrease expected free cash flows. But the main thing I wanted to point out today, the dichotomy of what's going on with the TCJA. If you're using, particularly with a C corporation, where we have lower taxes, we've artificially increased value. If the company doesn't do any better next year, it's worth more.
First dollar out, not $50,000. And so if you have a company that would not pay as much tax underneath the old system, but is paying more tax in the current system.
Oh yeah, that's under $50,000, as I said, so many minutes ago.
But so many of the companies we do are tax managed to pay zero or at negative.
Correct.
And so,
They're going to pay more tax. However, if they're keeping that amount so doggone low, and what do most small companies do? They sit down with their accountant in November and they see where they're going, and they take a zero paycheck the next month to gross out and increase the taxes withheld and everything, so they're okay, and they have very little income, and that's the way to control it, and they will still do that. But whatever is left in there is still going to be taxed at a higher rate, now at 21%, before when it was 15. So, okay, just some nuances. So again, it requires modification of the WACC. Limitation will add a complexity to the business valuation process, especially PTEs where carry forward tax benefits associated with previously disallowed interest deductions are realized at the shareholder partner level. This is brand new. Okay. With regard to depreciation, bonus depreciation rate increases to 100% for property and service after September 27, 2017. So be aware, if any of you prepare tax returns, that is before December 22nd when the TCJA was signed into law. So it gets backdated. And before January 3rd, 2023. The rate will phase down each year until it expires after 2026. Removes qualified improvement property as a separate category, eliminates a requirement that only new property is eligible. Now any property is eligible, and special rules apply to certain industries and businesses. 179, are you familiar with that? Okay. Permanently increases dollar limitation to 1 million, and the overall investment limitation is qualifying capital equipment to 2.5 million. Effective for years after 2017, expands definition of eligibility of qualified real property, accelerates cash flows in years of a capital expenditure, could drive capital expenditures to a greater level than normal due to favorable tax consequences, will drive a greater market for cost segregation study services. Now that's coming back strong. I used to do those in the late 90s. May drive longer discrete forecast periods as substantial tax deductions may not be realistic in all years due to phase outs. Okay, so those who say, well, I need to do a minimum 3-year, and those of us who are saying, I'd like to do at least a 5-year, we may now be going to 10 years, or understanding the business cycle, okay, and have to go longer. Capital expenditures in the terminal year calculations may be even more relevant than prior to enactment to the TCJA should the CapEx and depreciation still be equal in the terminal year. Okay, so that question is, I've always been asked, what do I do in the terminal year with regard to depreciation? And I say, to be safe, have your CapEx and your depreciation equalize one another. What that effectively is saying, once you're in the terminal year, whatever you have purchased and depreciated, at any time in the future is going to be fully depreciated, there's going to be no more depreciation. I've seen sometimes where depreciation exceeds CapEx, that's mathematically not good or correct. Okay? Now, but all this is telling you, it's going to be able to drive us to do more schedules of when we're buying, the company is buying CapEx, and plotting that out in this different schedule, plot out the depreciation, and then load those schedule results into your DCF. It's going to cause more work. Frank, do you have a question?
No, just, you just said that depreciation and CapEx should be equal.
In the terminal year.
I don't agree. I think CapEx should be higher. Right, because otherwise you don't have any growth.
Then maybe what I meant to say, at least 0 to 0. Okay? Yes, I've had occasion where I'm going to have CapEx. But I've also said that if you're doing, preparing a business valuation for a type of business, let's say like a doctor, their equipment is so doggone expensive. It could be an X-ray machine, could be an MRI. How often are they going to buy an MRI, or when so you may have a much longer DCF period in order to encompass 2 cycles of where they're buying equipment. Chris?
Deduct your depreciation and figuring out your cash flow, right? And then you add it back. So as long as you're adding it back, you end up in the same place you started with.
I don't disagree.
Regardless of what your number is. Your depreciation, whether it's $100 or whether it's $1,000, when you get back to cash flow, it's still the same number.
You're right.
So your depreciation really doesn't matter. Your CapEx just has to be right.
I'm just saying, looking at the theory of it, is
Well, it
really...
doesn't look good because, yeah,
That's
how
what
can you
I'm
have
saying.
$1,000 of depreciation? But all that means is that rather than having $1,000, if your CapEx is only $100 a year, your CapEx is going to be $100 going forward, but your income is going to be $900 higher. So you end up in the same place regardless.
Not entirely, because
Well,
the
the only thing
depreciation as an expense, as that type of number, is impacted only by the income tax to it. But now you're acting the full boat back of the depreciation to get the cash flow. You may be overstating that cash flow.
By the tax impact. Yeah.
Correct.
That's
all.
That's it.
Okay.
But you gotta drive the whole thing with CapEx. You don't drive it.
Right.
You have to drive,
Right.
what does the business need CapEx? And then what's the
I
result?
agree. Well, that's why I say sometimes you may have to go out further to capture a couple of cycles.
You also have to go out to get past the sunset application. So that's it.
Yeah. The TCJA effectively eliminates the current deduction alternative for research and development. The expenses incurred after 2021, the deduction remains, but the TCJA provides reduced accounting options, deferring the immediate benefit of such expenses. The elimination of the current period costs after 2021 will increase cash flows in those years. Consideration should be applied relating to the discrete forecast. Long-term amortization of these costs will require evaluators to be more careful when addressing these expenditures in the terminal year calculation. I haven't worked on too many companies in the past 20-some years that invest in research and development, but that's something to caution you with. Historically, a net operating loss was permitted to be carried back 2 years and carry forward 20 to offset taxable income in such years. The different carryback periods were applied with respect to NOLs arising in varying circumstances. Changes applicable for NOLs arising in tax years after 2017 no longer will be allowed to carry back, can be carried forward indefinitely, but also there's a limitation. The amount of future income that can be offset is reduced from 100% to 80% for losses occurring in tax years after 2017. The repeal of the 20-year carry-forward period will require evaluators to address full use of NOLs in the terminal year calculation. And what this is causing us to see, the absorption periods that we used to be having for in the DCF is now going to be extended into more years. Could be another 5 years, because 5 times 20%. Okay, so we could end up doing or preparing much longer DCFs. The new income offset limitation of 80% for NOLs generated after 2017 will work to decrease cash flows, as some level of tax will likely be paid in every year. What we're referring to in the years that we're only able to take 80% of a loss and not 100%, we're going to be taxed on that 20%. Understand? Okay, then when do we get the value of that 20%? In a DCF period that is now elongated, and what happens with the discount rate in a long period into the future, it's worth the dollar in the future is worth less than a dollar today. So there's a lot of impact.
Well, because you're only getting 80% of it. So even if you get down to 20% of the original 80%, you're only still taking 80% of 20%. So it's like a half step. So when you
You're saying the 20% is now added to a new 100% of an NOL, and now it's 80% of that. And that's similar to when we used to analyze the depreciation under the double declining balance. Thank you.
Zero, you approach infinity simultaneously.
It gets small but never goes away. So changes in the NOL carry forward rules will play a role in how business owners utilize the bonus depreciation rules and Section 179. 199A is the affectionate term for the qualified business income, affected for years after 2017 and before January 1st, 2026, or by the end of 2025. Taxpayer may deduct up to 20% of the QBI, qualified business income, from the pass-through entity. Deduction is available only at the individual shareholder, partner, member, or sole proprietor level. Now, what I'm finding, and you may have already seen this, a lot of the software that you may utilize for tax returns is only quantifying what the amounts of W-2 wages are and what the qualified income is for the QBI. Then you have to load those numbers into the 1040 software in order for that software to count the 20%. Yeah.
And, you know, they really haven't nailed down what a qualified business is.
Well, they pretty much in the new regs.
New regs?
They came out with new regs, and it's in your thumb drive. I made a lot of copies of different things. In fact, you know, we as business valuators, I was going, am I in one of those
Non-manufacturing manufacturers?
Well, businesses that I can get it, okay? And when they were listing, initially it was architects and different, and now they have eliminated the he's a financial architect. But the word financial grabs you, okay? And yeah, I have to tell you where you can find it. Let me.
So what did you conclude? Are we a QBI candidate?
We are not.
That's what I thought.
Because the headings are in the new regs. The SSTB is that, what do they call that? The specified service, trade, or business, okay? So health, law, consulting. I never found anything about us in consulting. But financial services. The PR limits the definition of financial services to services including managing wealth, advising clients with respect to finances, development retirement plans, developing wealth transition plans, the provision of advisory and other similar services regarding valuations, mergers, acquisitions, dispositions, restructurings, including in Title 11 or similar cases, and raising financial capital by underwriting or acting as a client's agent in the issuance of securities or similar services. So they got us there under financial services. So.
Sleep at the switch.
Well, the AICPA wasn't, or whatever, wasn't in our best interest.
I'm sorry, to go back to the NOLs.
Yeah.
I'm a little confused when the discussion went off about, you know, taking 80% and it never goes to zero. I didn't understand it to be that way. I didn't think that's
well, it can.
No, I thought it was. Let's say I got 300 of NOLs.
Okay.
Okay. So now this year I make $100. Okay. I can't apply $100 to that of that NOL. I can only apply $80 of NOL to the $100 of income, so now I have 20. It's not that I can take,
He's right.
I
He's
can't.
absolutely right. You see what he's saying?
Yeah,
The law is now written, and it's a very key point. I'm sorry I didn't make that clear. We cannot utilize any more losses to create no tax for a particular year. So if I have excess losses, and what Frank is saying, $100 of income, I can only apply $80 of my losses, even if I have $100,000 in losses, $80 of losses to the $100 because $20 is going to be taxable. That is correct.
Spread that out over
And
the
then
years until-
that's why they're saying they're giving us a lifetime to eliminate those losses if we're able to.
Because it might require
But,
time.
but what is the value of those losses in the future? Okay, that's all that I'm saying. It's unbelievable what has been done to us.
You know, if you think about it, especially with some huge mega companies that we have right now, that's a big issue. You got Tesla. They never had a profit. You got Amazon. They didn't make a profit until like the 10th year of their existence. And we're talking about billions and billions of
But
dollars.
initially they weren't interested in profits. They were only wanted name recognition.
Well, stock that.
But that's name recognition. Okay. All right. The QBI reduces necessary cash distributions for equity owner tax payments on corporate income, modifies the effective federal tax rate to 29.6 on pass-through income for tax years beginning 2017, after 2017, and before 2026 begins. May result in greater levels of investment in personal and capital assets. Value is equal to all future economic benefits that will inure to a holder of an asset over an investment period, reduced to a present value at a particular date of valuation. Two primary methods under the income approach is the discounted cash flow and the capitalization of free cash flow, what we normally do. DCF forecast cash flow over a discrete forecast period. The discrete forecast period is that 3, 5, 10, 12 years that you're actually creating. Not you are creating, your client is creating the cash flow, the forecast. Allows for significant modeling flexibility and varying growth rates. Typically involves a terminal year calculation at the end of the discrete period unless there is assumed date for an exit. I once had to value a debenture bond, and the bond had a life, so there was no terminal year. So you will sometimes come across some particular type of instrument or fact circumstance you won't have a terminal year. Assumes that cash flows will grow at a constant rate into perpetuity, less flexible than a DCF, and we're talking about capitalization model, but appropriate for companies with steady year-over-year growth in free cash flow. So if a company is mature and you are expecting the next year to be the same except for maybe some few differentials, then you can apply a growth. Now when you're doing a DCF, remember there is different growth. There's growth at the revenue, there's growth at the gross profit, there's growth at the operating income, there's growth at net income, and there's growth at cash flow. But in our literature, when we're talking about growth, we're talking about earnings, net income, okay? Critical determination under the income approach is the point in time at which growth in cash flows is expected to stabilize, based on when all of the contributing factors to free cash flow are expected to grow at a constant and sustainable rate. Profitability, capital expenditures, and working capital. Provisions of the TCJA could have a profound effect as to when it is reasonable to assume constant growth in free cash flows. Application of the depreciation rules, Section 179, the NOL, deferral of tax advantages attributed to research and development, and so forth. We have a lot more to consider we ever had before. The free cash flow to invested capital, net income plus depreciation minus capital expenditures plus or minus the incremental working capital plus the interest expense times 1 minus the tax rate. We know what that is. That formula is represents the amount of cash flow available to all holders of invested capital, both debt and equity. The key considerations: federal income tax rates, the taxable income and deductions, and net operating losses. So prior to the TCJA, C corporations tax under the graduated rate system, the highest rate being 35%. I love when people, and even Van Vliet and those who use 35%, do you know that that starts at $10 million of income? I don't think I will ever do a valuation that high.
Budget reports on actual effective tax rates for corporations in the U.S.
I read it a long time ago and it was very low.
For large companies.
Yeah, for large companies.
But what their definition of large companies is revenues over $10 million.
Right, right.
The actual tax rate, I think in 2016 or 17 was around 17%. Or 15, so prior to TCJA. So even though the tax rate is at 35,
they're not paying it.
no, it's 7. They're paying less than 20%.
Yeah, but the 35% they're talking to is not in revenue. It's talking about actually operating income.
Yeah, yeah. But overall, large companies are paying just 17% of their income. So I think the whole thing is, I just said we're not in the exact business here.
Yeah, well, that's true, and then, that's when the Warren Buffetts of the world say we're not paying enough, and, what's his name, Microsoft, Bill Gates just now, last week said the same thing. I don't pity them at all. They're earning dividends into the multi-millions of dollars, and they're paying capital gains rates, so give me a break.
I probably shouldn't even mention it because I don't remember where I read it, but I remember there being a discussion. This happened to be Russia, and at one point in time they had extremely high tax rates. Well, what they found is that the National Treasury wasn't getting any fuller by raising the rates. What they found is just more tax fraud, more tax evasion, and people finding legal ways not to pay taxes.
Well,
so what they discovered is, well, let's lower the tax rates, and the coffers actually got more full. So,
can't afford the lawyers.
Yeah, I mean,
well, that was true. The moment Reagan reduced
the market will only sustain what it's willing to sustain.
Yeah.
So,
it's all a game.
Some of us win, some of us lose.
Yeah. Many valuators have tax affected not only C corporation taxable income in the course of evaluation, but also the PTEs as well. As you know, I'm in that camp. Does that mean that a specific company's value is increased by 21.5%, the amount of the difference in the pre-TCJA marginal rates and post-TCJA marginal rates? So if $100,000 less taxes than $65,000, 65 is being my cash flow, and my capitalization rate is 20%. Then my taxes here now have dropped by 14% to $21,000, and I now have increased value by $70,000 just by the fact that I'm paying less tax. Okay, so the difference here to here of the 14,000 equates to a 21.5% pickup of cash flow. In its most simplest terms, okay, most simplest. On the surface, it would seem that the cash flow in the numerator will be increased by these tax savings. Assuming the same risk rate, greater cash flows in the numerator should practically lead to greater value. The magnitude of the tax benefit from reduced rates will vary from company to company. We said that. Benefit will not simply be the difference in the cash flow associated with the tax rate reduction, but rather the difference in the effective tax rates paid by companies after taking advantage of all of the provisions of the new tax law as compared to the old law. So an example, ABC, $20 million in taxable income, pre-TCJA, state taxes 10, federal taxes 35, post, this state is still the same and Fed reduced to 21. And similarly, as we saw in the other graph, 20 million, 2 million is taken off for state as a deduction. Taxable is 18 in both scenarios. The federal tax pre 6,000,003, post 3.78 million. Therefore, the after-tax income is 11.7 and then 14,220. The total taxes of the 2 million plus 63, 2 million plus 37 and 8 is 8.3 million, 5.78 million. This equates to the a tax rate of 41.5% as opposed to 28.9%. And a lot of literature today are using this kind of comparison and now saying that is the blended tax rate as opposed to the 41.5 to 28.9. That just shows you in real numbers, and I use the real number in quote because we don't always value a $20 million company. Key considerations implementing the changes into evaluation: interest expense limitation, the capital expenditures and associated depreciation and expensing, research and development expenditures. In calculating free cash flow to invested capital, the cash flow impact of interest expense and the corresponding income tax benefit is added back to net income. Limiting interest expense does not change the output of our previous cash flow equation, but it does require an adjustment to the underlying equation. So the free cash flow to invested capital equals net income, again, plus a depreciation amortization, deductible interest expense, not total interest expense, and then non-deductible interest expense, capital expenditures, incremental working capital. So what we're saying in our context, if we're getting income tax statements and they're limiting the income and interest expense, we now know we have to look further, okay, in order to get to proper cash flow. Yes, and that's the kind of valuations you do every day, right? I as well. I just recently prepared valuations for oil and gas entities, and I spoke to the CPA, and she was out in Tulsa, Oklahoma, and there were 12 entities I had to value for an estate. And I said, what are you allocating for possible income tax? He says, well, we're hoarding, if you will, $10 million. That was pretty cool. Implications of limiting deductions of the interest expense. Debt financing will be more costly for companies than before, right? Because the interest expense is now limited. The interest expense is limited as a deduction for cash flow, and the WACC is going to cause the blended WACC to increase. Okay, so the capitalization rate, being a cap rate, particularly to the WACC as a cap rate, is a divisor. If the divisor goes up, what happens to the value? It goes down. Okay, interest expense deduction limit is not static year over year due to how it is calculated. This will likely create significant year over year valuation impacts, altering current income tax liabilities. Example, a highly leveraged company might have a poor year in profitability, reducing its adjusted taxable income and therefore reducing the maximum allowed interest expense deduction. The company might be recognizing a loss after factoring total interest expense in, but may be required to recognize taxable income if not all of the interest expense is deductible. We covered that. Company could be faced with paying both taxes and interest expense in a year of low profitability. Any allowed interest will be permitted under the law to be carried forward indefinitely. However, for PTEs, the carryover considerations are at the equity owner level, not at the equity level. It changes the dynamics. Modeling disallowed interest will require a determination of when the interest may be deductible in the future. So where we may have calculated when we purchased cap decks and created schedules and prepared the depreciation and how that hit many different years, now we have to consider interest and losses. TCJA significantly accelerates the recognition of depreciation expense. Depreciation is a non-cash expense, which we know. Assuming no changes in tax rates, the total depreciation benefit over an asset useful life will be the same. But accelerating the recognition of the benefit increases its near-term cash flows and invested capital present value. Lower federal income tax rates will serve to reduce the income tax benefit of depreciation and decrease the present value of invested capital. Accelerated recognition of depreciation expense will increase the present value of invested capital. Accelerated write-offs of capital expenditures are not as valuable as in the past due to the significant reduction in the corporate income tax rate. So a company is planning to invest $2 million into a new piece of equipment with a useful life of 5 years. Assumptions: prior to the TCJA, 41.5% tax rate, $500,000 expense under 179, additional 50% bonus depreciation in half-year makers. Under the TCJA is 28.9% tax rate, full $2 million expensed immediately. Oh, good, you can see that fairly well. All right, so if in year one, prior to the TCJA, you can see the depreciation expenses are being allocated by makers, right? So I'm going to have depreciation each and every year. But under the TCJA, I'm able to take all $2 million and I'm not going to have any further depreciation. That being the case, that's at a higher tax rate, even if it's spread out, but the whole $2 million is at a lower tax rate. And actually you do the math and it results to less of a value here to here, the savings. What is internal revenue always looking for? More tax. Isn't this a way of getting it? Okay? So there are potholes in the TCJA accordingly for what in the context where we're coming from. Okay? I think this really is one thing I really wanted to have in here to show you so you can see the impact. Takeaways. Present value of tax benefit will be lower under the new tax law than the old law due to lower tax rates. Acting.
Your tax rate instead of deducting it all.
You want me to go back?
Yeah, if you was this one. If you took the depreciation expense instead of $2 million, but using it on a straight line instead of at once, it's actually even worse than that if you discount it to a net present value.
Oh, absolutely. Absolutely, because what happens is you're taking it at this tax rate across, but now it's being impacted by a lower factor over time. So it gives you even less value. Okay?
Deduct it all now, but from
Yes.
an appraiser's perspective, we need to even out the cash flows.
Absolutely.
And
It makes it worse.
And it makes it worse.
Or it makes it worse. Okay.
And so how do you reconcile those two differences?
I don't know right now. Right?
I've got no problem with that.
All right.
table. I have no problem with that table. You're looking at tax savings.
Yes.
Shouldn't you really be looking at taxes spent?
Well, that's
Isn't
another
that
way.
one?
I
It's
just
not the same, is it?
Just the inverse.
Not so sure.
Well, it's net sum zero, isn't it?
Well, I mean, this is the tax rate, tax spent. But we're looking at from the aspect, instead of this being a taxable item, we're looking at it in the light of a tax savings by adding back a non-cash item. That's all. I'm not trying to trick anybody. I'm just trying to show comparatively doing these two things the same way creates less value.
Well, it's going to vary based on your present value factor.
Well, we said that.
Yeah, it doesn't matter what it is. The simple fact that you're
I'm only trying to show how it's going under the new law. Not everything was a panacea to the positive with this law for us, and it's made our jobs harder. I know as a newbie, you're loving to hear this, but it has. But it's fun. I mean, I love what I do, and I hope everybody does too. But then try and explain it.
What we need to do is come up with a dichotomous tree that shows decisions.
Dichotomous tree. Branching that way. Okay. For a profitable company, the overall decrease in total taxes paid in each period more than offsets the lower present value of the depreciation tax benefit, resulting in an overall net increase in value. After 2021, existing methods for expensing research and experimental, I'm behind that hard to say because I'm so old that we used to call it R&D, research and development, expenditures will be eliminated. The eliminated methods are the methods that allowed accelerated recognition of these expenses. Lower tax rates coupled with a more delayed recognition of these expenses will decrease their present value. And once it goes away, obviously, it's going to decrease value. No, it's going to decrease value because it's no longer an expense, more income to
Your software companies, your drug companies, how are they going to, your chip manufacturers?
Well, a lot of people are worried that's going to end up costing us more in drugs. But the weird problem is, you can go, if you take a brand name and you buy it from the pharmacy here, and you can buy it from in Europe, you can pay less. And the pharmacies here are doing a number on us because I had a valuation with regard to this, and this is nuts. Any of you familiar with an open pharmacy and a closed pharmacy, the difference? Open pharmacy is any Walgreens or CVS or anything you can walk to. A closed pharmacy is generally a warehouse, and they will sell to specifically skilled nursing facilities, assisted living facilities, and hospitals. Pharmacies give them an automatic deduction on the cost of drugs. In aggregate, the TCJA provisions will negatively impact value of NOLs going forward as they primarily work to defer their use further into the future. We had discussed this already. Note that, like depreciation tax benefit, the dollar amount associated with an NOL will also be lower going forward due to lower tax rates. Companies with existing deferred tax assets reflective of future use of NOL carry-forwards may see significant decreases in their total assets on their balance sheets as the value of these benefits is adjusted downward. The most appropriate discount rate for free cash flow to invested capital owners is the weighted average cost of capital. You know the formula. The tax structure, cost of debt, cost of equity. We've been discussing a lot of these already. Optimal capital structures will vary from company to company based on differences in the stage of their life cycle, industry, risk, competitive pressures, and company-specific risks. The debt generally creates more strain on a company's financial position due to contractual repayments, loan covenants, and default risk. Debt financing is generally specifically less expensive than equity financing, and interest expense has historically been tax deductible, thereby creating cash flow through the corresponding tax savings. All else equal, limiting the deduction of interest expense makes debt financing less attractive. It remains to be seen whether or not the provisions of the TCJA will create any material shifts in capital structures on a market-wide basis. The pre-tax cost of debt is the interest rate at which debt financing is available to a company. Due to the deductibility of the interest expense, the true cost of debt is lower by a factor of 1 minus the tax rate. Lower corporate tax rates under the TCJA will therefore increase the after-cost cost of debt, which we've discussed. Higher discount rates decrease present value calculations. So again, as a reminder, in one sense, if we're doing a straight capitalization, particularly with a C corporation, we could have increased values. But if we move to a WAC, we could have lowering values. So the TCJA has created a mixed bag for us, all things considered. Not only interest rates, but depreciation, interest, and NOLs, and research and development. Okay? It is unclear as to whether or not the TCJA will impact rates changed by lenders, the pre-tax cost of debt. So looking at this simple comparison, a pre-cost of debt prior at that tax rate is 3.5%. Under the TCJA, 4.3%. So the cost is going up, therefore the cost of the WAC is going up, and value will go down.
Lenders care about this point because they're looking at their cost of money, and that is directly to the Fed in their local accounting.
Do we need to go?
No, absolutely not.
Absolutely not.
No, we need a gold standard.
It's something that was created by the banks to protect the banks.
Yeah.
But the banks use anything as an excuse to charge us more sometimes. But even though they utilize 3% or 300 basis points plus the overnight rate, and I understand that. But sometimes you find in some community banks their interest rates may go up. But this I put in there just as a moment. But that's all.
I think it is interesting. I don't know if it's quantifiable because you have so many factors that go into that. It's certainly a small component if it is in there. But yeah, it could potentially have some influence.
Sorry to have such a technical presentation at the end of the day.
You could have done it in the morning when no one's awake.
Well, you could have done it right after lunch, and we could all have a good time.
You would have slept through it. At least you're a little awake now. Discount rate, cost of equity, and the build-up. At the current time, there is not sufficient information to quantify any expected changes in the cost of equity due to the passage of the TCJA. But in fact, there's other elements that come into play. So before the TCJA and under the TCJA, I don't think our components of the cost of capital are really going to change. Assumptions: 17.2% cost of equity, 6% pre-tax cost of debt, 3.5 after tax, and 4.3 after under the TCJA. Capital structure is 70% equity and 30% debt. As an illustration, so we have our weight of debt and the weight of equity. They will always must equal 100%. The cost, what's particularly changing, is going from 3.5% to 4.3%. And this is what you're going to see occur, particularly for small companies, that I have 13.1% and 13.3%. Is that a significant difference for a small company? No. You're going to be talking about hundreds of dollars. But if you're talking about a company doing $20 million or more, you're going to be in thousands of dollars, maybe sometimes hundreds of thousands of dollars of difference. Now, I get a lot of pushback all the time about this, but if there is interest-bearing debt, why wouldn't you at least consider a WAC? And I get a lot of push on it, and I even have people in the class, I would never consider utilizing a WAC with a small company, and I hear that mostly at the back door. You can't. You can't.
Look it up under Pratt stats and figure out what the debt ratio is. But that is such a minute sample of all of those companies that are out there. And if the ones that are sold are...
No. Because some of your NAICS codes have a plethora of companies. But you get to some obscure one or specialized business, I totally agree with you. You're not going to get enough comps because there's many times, to me, you need at least 6. Now, if I have less than that, and you have to remember, you can't commingle the asset sales with the stock sales. You cannot commingle the
public companies purchasing private companies that are private funds.
and what
There's a question about SBA funds versus non-SBA funds. Because the ones with SBA funds tend to always...
well, again, and also you can't commingle the asset and the stock sales, and okay. So you have those groups that you can't. Now, what I will do sometimes, if I'm working in an S and only get a few, then I'll go include the partnerships. And then I may include the LLCs because they're all PPEs. But they're really significant difference because a corporation can really act differently than a 2-person or even a disregarded entity if they're recorded as an LLC. So I get your point, but it just causes us to do more research. But
I tend to only use the WAC on larger companies.
This is just showing what the dynamics here is going to happen, and that this is definitely going to go up under the TCJA. However, we know mathematically for small companies it's really not going to matter that much. However, for larger companies, it could.
Well, I'm just saying that small companies used to reverse those at 30/70 instead of 70/30, and all of a sudden that drops tremendously down, and that gives you a false representation of the value of the company, even though that isn't a particular company.
Well, a lot of times you're doing an inside deal for the reason for the valuation, but if you're comparing it to market, and this happens to be 60/40, it's a whole other different dynamics.
Or a 37 just flip on.
Yeah, if it just flips, right. That could occur too, but then you have to warrant whether you have to realize more specific company risk because of the dynamics of the 70 down here, and that's a whole other ballgame. I know it's throwing dice, but okay. But again, it's with different balls up in the air and so forth and so on, and that's part of the art. This is just, based on the 13.3 that we know. I know it's oversimplified, but I again just wanted to show. It's like almost in one of the books that Pratt wrote many years ago, that the value changes based on the dynamics of your denominator, which we know. Lower tax rates may not be dollar for dollar trade-off price competitive industries. Such of the intent of the TCJ is to spur economic growth. Another major consideration is the plowback of associated tax savings produced by the TCJA. I should have put in there the plowback of the perceived tax savings. Additional investment in personnel and capital expenditures should result in greater cash flows. Yes, that's greater expenses, but if they're able to produce more income per head, as we do in some comparisons of certain industries, then yes, the business is going to be doing more business. The TCJA will impact the income approach, model selection, cash flow calculations, discount rates. The most impactful element will be the change in the federal corporate income tax rate. We know that practical application apply market-based multiples to subject company metrics. Market approach, guideline transactions, guideline public company, past completed transactions, and rules of thumb. And that doesn't mean, what's the value? Impact on guideline transaction method, increase in free cash flow will increase business values. Impact on transaction multiples, after-tax multiples, pre-tax multiples. We discussed much earlier today with Chris that quantifiably with the small company transactions, we do not have enough data out there that will allow us to know that they're impacted as yet by the TCJA and have changed value. With very small companies, if you're using price to revenue, I was asked by Ray Miles, may he rest in peace, who was the founder of the ISBA, to prepare a marketability study on their database. And I found that if you took all the data in its entirety, even though it's from 1980, you received a better regression analysis than trying to stratify geographically or the last 5 years or limited to a group of revenue. And that has not changed. So, with small businesses, in 1980 it was 60 cents on a revenue dollar back then. It's pretty much the same today. It's amazing. Impact on sufficient levels of data may be unattainable under the guideline transaction method in the short term. We have cash flow, old law, new law, what the changes, okay, and how that equates in the metrics change just based on the nuance of having more cash flow to deal with today based on the TCJA. Okay. Now, you may say, well, these numbers aren't too significantly different. That is true. With small companies, they're going to be worth slightly more. And then again, with larger companies, because of the changes in cash flow, it definitely is going to be much more money. Taking you through the same, but a little bit more in depth. Revenue, EBITDA, less depreciation, EBIT, less the taxes, earnings, and plus the depreciation, get down to a cash flow, 1670 to 1922. Change is $252, 15.1%. And again, the comparing the actual to adjusted representative metrics, their change and the percentages. So in this simplified form, we have in essence a 15.1% change. No, this as a in and of itself, not across a whole range of anything. Yes, that's all. But for a large company, that's a sizable change in value. Impact on guideline public company method, efficient market hypothesis, considerations for evaluators, date of the valuation considerations, matching multiples and benefit streams, application to subject company, avoiding duplication of expected tax benefits, and assessing future cash flows. I only have 100 more slides to go through, so just bear with me. Oh, I'm not going to get to the end. I told you I wouldn't ever. Required to be considered in every valuation prepared in accordance with professional standards. The approach is relatively easy to understand based on the economic principle of substitution, breaks down a company into a set of assets and liabilities that will act as elementary units in developing its value. Determination of values is predicated upon an assessment of the current value of the company's assets and liabilities. Okay. Most common method, the evaluator restates all the assets and liabilities of the subject company from their historic cost to the appropriate standard of value. Now, I see mistakes with happening all the time, that the evaluator is picking and choosing which asset account they're restating to fair market value. You're obligated to look at each and every account and restate them to fair market value. After the reevaluation of the assets and liabilities from the respective historic cost basis of the fair market value, netting the two adjusted total is deemed to be the market value of the subject company's equity. I would also proffer to you, once you have attained a restated equity, that is your high liquidation value. Okay? Before, which we heard earlier today, about taking into consideration the liquidation aspect, whether it's forced or orderly. But that's our first tune, if you will, to valuation, that, okay, now I got to see if my young approach or market approach are going to be greater. If they're not, then I have to revert back to the balance sheet. Now, whether the balance sheet you have figured out that may have had any excess non-operating assets, there's no double counting it. You've just moved it from one account to another, but it still hasn't, it helped you create a value greater than the equity. So now you're back to the balance sheet. You understand this. I'm not going to belittle you in your time. You've seen the change. If the required asset and liability adjustments generate market asset values that exceed the tax basis of those assets, it is necessary to make an adjustment to reflect the deferred income tax effect of the unrealized gain or loss. Now,
value in place to use as your high watermark on the asset for a going concern. However, if it's a non-going concern, you're required to use the liquidation value.
correct.
Okay.
Correct. Okay. So there are 6 court cases that have proffered that 100% of the built-in capital gains may be deducted. Now, one of those 6, there was a dissenting, or, he was a dissenting judge, and he stated he felt if it was not eminent that in a short period of time the business would be sold and therefore an actual amount of built-in capital gains would be paid, this judge felt that it, and he didn't give us any guidance, he just said that he felt that the value of the capital gain tax should be present valued. I use the prime rate to do that over a 20-year period. Doesn't change my month, but okay, I'm being ever thoughtful that I know that this business is going to exist beyond 20 years, so I'm giving some present value to that effect. I'm subtracting that amount from my equity. And then if I'm dealing with a minority interest, I'll probably take in a DLOC and DLOM as well. So the amount of the unrealized gain on any asset is equal to the fair market value of the asset less the tax basis of that asset. We know. You know that. Reduction in the highest corporate rate from 35 to 21. As before, the TCJ provides no lower preferred rate for capital gain income under subchapter C of the code. Since the change to the tax rate is permanent, the corporate rate at 21%, the tax liability decreased with the enactment of the TCJA, resulting in an increase in value. You know that. You understand that. The conversion of a C Corp to an S Corp generally does not trigger an immediate tax liability, but there may be some trailing tax consequences under IRC 1374. Where this is significant, if a C converted to an S during pre-TCJA, it's old rate tax you have to consider, not new 21% tax rate. Okay? Now, conversion used to be a safe harbor period of 10 years. Went to 7, now it's 5. Okay? So what that means, if you're unfamiliar, if an asset has sold during the safe harbor period, a prorated amount of tax at the 2017 and prior period when you made the conversion, so we're in that period where that could happen, you have to take that into account. Okay?
You said prorated. I thought it was a cliff. If you didn't meet it, then whatever the tax due.
You get benefit for the maybe 2 years, now the third year. Okay? So you get benefit that you were in S for 2 years, but you have to pay based on the remaining 3. So it's prorated.
Okay, that's part of prorated.
Yeah. At the time of the S election, the electing C corp is required to make and calculate the amount of built-in gain that has been. And I've had an occasion where this has come to me, and the client said, "I never had a valuation prepared when I changed from a C to an S." So you need to do 2 valuations. You need to capture the appreciation and what is the built-in capital gains for possibly for 39 states, the state tax and the federal tax. If any of these assets are sold during the 5-year period allowing the date of conversion, the built-in gain will be subjected to income tax at the corporate level as if the corporation remained a C corporation. Support for tax affecting S corporations. Calculate the value as if it were a C corporation. Account for differences between corporate and individual income tax rates. Calculate the benefit of the avoidance of dividends tax. Quantify the ability to build up basis in S corporation stock, similar to the original Nancy Fannin model, which is no longer endorsed by Nancy Fannin. Yeah. So we have prior and post 10% state, federal taxes, and we've seen this before. Total provision for income tax that was in another model. You can go back to it. I just restated it so you could see it. Valuing S corporations. Historically, the tax rate differential between the highest corporate and individual income tax rate was minimal. The Pennsylvania C corporations have a 28.9 effective tax rate. Owners of pass-through interests who actively participate have 40.1% effective rate if the business does not qualify for the QBI deduction, and 32.7% if it does qualify. So we'll look at the next slide. So we have pre-tax income, 20% QBI, federal, state, federal tax rate. Then we're adding a component for, that didn't go away, the 3.8% passive rate embedded in Medicare. So capital gains rates on the Fed side technically are 23.8%. Okay? So this gives you a chance to see how the rates will change. And this is without passive income. This is with passive income. This is post TCJA and with the passive income and how the rates will change. So give you a little bit of inclination how that works. Threw that in for you. I told you that we have 2 components. We have a state tax and a county tax. So look at the rates. Whoops. Maryland is the 5th highest tax rate in the country. Yeah. Yeah. Pennsylvania tax rate is 3.07%. State. But there's a county tax and a school tax. So, no. I didn't get to anything. Oh, geez. All right, quick reminder sheet. So bear with me. Yeah, okay. All right, well, thank you very much.